Hello and welcome everyone. My name is Harshmeet Singh and I welcome you all to today's session. This is your next class for economics in this ongoing prelims crash course. As you know, we have been discussing the most important topics that have been in the news from economics, especially keeping in mind this year's prelims examination. We have already had 8 classes so far. In case you have missed out on any of the earlier classes, please make sure that you go back and see all those classes, since we have covered a bunch of important topics along with practice questions on all of those. If you are some of those who is thinking that my plan is to give the examination next year 2026 or maybe beyond that, you need not worry, because we here at Narayana IAS Academy also have courses to offer to you. These are the courses that we have. There is a 1 year and there is a 2 year course depending upon whatever is your target year. These courses make sure that you are completely prepared with all the stages of the examination. It will have complete preparation for the prelims, the mains examination with special emphasis on answer writing, current affairs classes, and also a specially designed timetable looking into your own requirements, what are your strengths and what are your weaknesses. If you want any other information about any of the features that our courses offer and much more, please check out the description in this video. There will be a link that you can click and you can see our website where all this information will be available. We'll be more than happy to answer any question that you have regarding those. On that note, let's come back to what we are here with you for today. Now, as you know, this crash course is designed to make sure that all the important news regarding economics especially are discussed here one by one. With each and every topic that we discuss, we have a few practice questions as well and a related previous year question as well to help you strengthen that particular topic in your mind. Let's see what the first article or the first topic is today. The first topic that we have for you today is RBI's AI Mule Hunter. Now, what exactly is it? It seems like the name of a very secret James Bond mission, but that is not the case. What exactly is this? Let's first try and understand what are mule accounts. So, mule accounts are those accounts where a person unknowingly may actually give his or her account away to be used in illegal transactions. So, let's say there is a person who is doing something illegal. He or she wants to bring some money into their account. Now, they know that if they bring in unaccounted money or black money into their own account, they will be on the lens of the authorities. The authorities will look at them and authorities will take action against them. So, what do? They try and find out those innocent people who are willing to give away the control of their account or give away details of their account in exchange for some small amount of money. Let's try and take as a very simple example. Let's say you have a bank account. I tell you that you give your ATM card to me, you give your passbook to me, I will operate your account. My money will come in, my money will go out, you don't have to worry about it. In return of this, every single month, I will give you 50,000 rupees. You would think it's not a bad deal for you, right? You don't have to do anything, you just have to hand over the ownership or the control of your bank account. You don't have to do anything else. In return for that, you are getting 50,000 rupees. But little do you know that this account that you have now given away is being used for illegal activities. This is where this account will be called as a mule account. Now, what RBI has done, they usually anyways for many years have been doing this. RBI tries to identify all these accounts. They try to identify the accounts where something wrong like this is happening, where the accounts are being misused without the knowledge of the account holder in most cases, and they try to shut them down. So, it is not something new. What's new, why it is in the news, is that RBI now says that they will be using AI, they will be using artificial intelligence tools. So far, it was all done manually. Manually, the banks were given certain directions that look into the accounts where suspicious transactions are happening, where the person might not have a job or might not be working, but a lot of transactions are happening to and fro from that account. Look into all those accounts, and when something wrong is being highlighted in those accounts, please take action against those. So, that was till now all done manually. Now, how it is different? RBI now will be using AI, that is artificial intelligence, to catch hold of all those mule accounts and take action against them. So, this is where this has become important news. The reason why it is in the news is, as I said, RBI had announced that there has been a development of something called mulehunter.ai. That is an AI powered tool. The idea is simple. Whatever bank accounts are being misused to commit financial frauds, those are detected and those are either shut down or those are kept under surveillance. Something like this must happen with those accounts so that the RBI can clean up our financial system. Now, these accounts, mostly as I said, are used for the activities of money laundering. Now, I hope all of you have read about money laundering. Money laundering is a big concern in India. We, in fact, in India have a specific law called PMLA, that is Prevention of Money Laundering Act. The PMLA Act is the one that actually empowers the ED, Enforcement Directorate, to take action in these cases. A lot of students have this confusion or doubt as in what is the difference between ED and CBI. Where is it that CBI comes in the picture? What cases do they take up? And where is it that ED comes in the picture? What are the cases that ED would take up? The difference between the two is ED specifically is designed as a body to take up cases related to money laundering. Now, what do you mean by money laundering? In simple terms, when you try and use your black money or unaccounted money on which you have not paid taxes, you have not disclosed the source of the income, when you use that money to buy something legal, or when you use that money, transfer that money into some other instrument, let's say you buy property by giving a lot of money in cash which is unaccounted for, you buy some jewelry, you buy some car, that is money laundering. That is why today, if you go and buy a high value asset from big showrooms, let's say you go and buy jewelry, you go and buy a car, or you go to a builder and say, I want to buy a flat. In most of these cases, they will not accept 100% cash payment. They will say you can only give cash up to a certain amount and then you have to pay via check or via bank transfer, because when someone pays cash, you don't know the source of that money. So when that money, unaccounted money, that is black money, is converted, that means something is bought from it. That is called as money laundering. And these money laundering cases are the cases where ED, that is Enforcement Directorate, comes into the picture. Now, one more thing here that you must know about ED. ED, that is Enforcement Directorate, does not look into cases of theft. Please understand the difference. Let's say there is someone who robbed a bank. You go to a bank, you took out crores and crores of rupees and you kept at your home. Just because you have stolen that money, ED will not get involved. It's a police case or it's a CBI case. But when that money now is used to buy something, now you are using it for some purpose, that is money laundering is happening, then the ED comes in the picture. So ED will only come in the picture once the money is tried to be laundered. It's not just about theft. So ED or money laundering these are the usually kind of activities that take place in these accounts. These are often created or acquired by misleading individuals. And again, as I said, this is usually done without the knowledge of the person who has the account. As the example that I gave you in the beginning, that you have an account, you don't have an earning opportunity. Let's take this example. There are so many Jan Dhan accounts in India now. The government of India says that there are 50 crore Jan Dhan accounts in India right now. So Jan Dhan accounts are accounts which are zero balance account. There would not be much transactions here. There would not be much money flowing here. So assume that a businessman goes to a Jan Dhan account holder and tells him that you give me your ATM, you give me your passbook, you give me your checkbook. I will be the one using your account. My money will come in, my money will go out. You don't have to worry. In return, I'll give you some money every single month. Why would they say no? So victims in these cases are promised easy income or they may be forced into participating because again, they may require some money. Now, what are the consequences of it? What can happen as per the RBI? Number one, the account holder becomes a prime suspect. So again, if something wrong is happening from an account, illegal money is coming into an account, the first suspicion obviously goes into the official account holder. So whoever is the official account holder on whose name the account is opened, they will be the one who will be the prime suspect. And then there are financial losses as well. They may lose their own funds as well. Whatever funds that they might have kept in their own account, whatever funds that are coming legally might also get lost in such cases. This is where the RBI has come in. In fact, and as I said, it's a common occurrence. It's not something that is happening for the first time. The only difference now, why is it in the news, is that RBI now will be using AI tools and won't do this work manually. It used to happen earlier as well, just that it was happening manually. So approximately 4.5 lakh mule accounts were frozen across various banks in last year. So as I said, it's a very continuous kind of an exercise. Every single year, banks continuously have to do this. That is, keep an eye on those accounts in their banks from where very fishy kind of transactions are happening. And again, in most of these cases, these transactions are happening without the knowledge of the official account holder. Because for the official account holder, the only kind of advantage from here is that he or she is getting some amount of money at the end of the month. They are not aware or they are not concerned about what is happening in my bank account. This is where it's a threat not just to the economy, it's a threat not just to the businesses, it is also a big threat to the official account holder, because their account is being misused in most cases without their own knowledge. This is how money laundering makes a very important or keeps a very important handle into all these money mules account. Because money is withdrawn, you don't know the purpose of where the money is going, you don't know the source of this money, and this is where RBI thinks that the use of AI, the use of tools will make it easier and more efficient from them to actually keep an eye on these accounts. This is something that RBI has been worried about. You anyways, whenever you read about India's economy, we always read about the fact that India has a big parallel economy. Big parallel economy means there is a huge amount of money in our economy which is unaccounted for. This is what leads to the issues of money laundering, and the source of much of this money is these money mule accounts, which is where the RBI now wants to make a difference. This is the initiative. Now, this initiative is launched by RBI. Within the RBI also, they have an innovation hub. This is called the Reserve Bank Innovation Hub. So this is the kind of R&D or research unit that works within the RBI, that works on new kind of technology related to the banking sector, that can suggest new changes or new initiatives to RBI. They are the ones who have been behind it. They are situated in Bangalore. They have partnered with banks to identify 19 patterns of these behavior. So there are 19 parameters that have been decided. Parameters, for example, can be when a big lump sum amount of money comes in and then the money gets distributed at many different places. Or for example, let's say when the account holder is a senior citizen. So account holder, let's say maybe 70, 80 years. So most probably is not working. But even then, lot of money is coming into that account, lot of money goes out, money coming in from different accounts or different kind of accounts every single time. Because see, usually if you're a salaried employee or if you're working somewhere, usually the money that comes to your account is from a same account. But when every single month money is coming to your account from different areas, from different people, from different account holders, that is also a cause of concern. So like that, there are 19 patterns or 19 parameters that have been decided here by the Reserve Bank. On the basis of these 19, accounts will be checked, and accounts which fall under these category will be flagged by this AI tool. This is what they do. First, they integrate AI/ML. AI/ML is artificial intelligence, is for AI. ML stands for machine learning. Since we have crores and crores of accounts in India, it is not physically possible to just do it all manually. For a long time, it was done manually. Just that with manual checking of this account, it also leads to privacy invasions. You can't have someone sitting in the bank going through each and everyone's account, keeping an eye on what are the different types of transactions happening in the people's account. So you can't have that. That's not an ideal situation, because that's an invasion of privacy. This is where you have to use these tools and machines, and AI has come in. Also, it will be much more efficient. It will reduce the possibility of false positive. Now, what do you mean by false positive? False positive is a phrase that you will see used quite a lot, let's say in vaccination, in diagnostic testing as well. False positive, for example, means, let's say you are getting yourself tested for a disease. Let's say there is a test that has been conducted to see if you have malaria or typhoid or something. The test might say that you are positive, means the test might say that yes, you have that disease, but in reality you might not have that disease. So the test has given you a wrong reading. It has said that you are infected by this disease, whereas in reality you are not. That is called as false positive. For example, when the COVID-19 crisis was at its peak and people were getting tested for COVID, there was some problem of false positive, especially after the vaccine that you had taken. because the vaccine microbes were detected inside the body and the test assumed that this is COVID, so they gave a lot of false positive. Now, false positive reduced means the efficiency will increase. We will have much more efficient result. We will be able to earmark which are the accounts which show this mule hunter account kind of a behavior. Also, it will identify 19 patterns as we discussed. Patterns would include a lot of stuff about the pattern in which the money is coming in, the pattern in which the money is going out. All this will be taken into consideration, and then certain accounts will be flagged by this AI tool of the RBI. Just give me a moment, just a second. Yeah. If you have read and understood this entire thing, I hope you should be able to answer a few questions. Let's see if you can. Read this carefully. Read all the statements on the screen and see if you can get this right. I'll give you a few seconds. Read this carefully and then we can discuss. All right, I hope all of you have read this. I hope all of you have logged in your answer. If you still have not, you can maybe pause on the screen, think about what the answer should be, and then we can go ahead. So the question is, with reference to mulehunter.ai, recently introduced by the Reserve Bank of India, consider the following statements. First statement is, Mule Hunter AI is an AI ML based model developed by Reserve Bank of India, Reserve Bank Innovation Hub rather, to detect mule bank accounts used for financial frauds. Exactly what we discussed. This is a tool that is called mulehunter.ai. It is developed by the Innovation Hub of Reserve Bank. The idea is to detect what are mule accounts, and if you have just joined in, I'll repeat once again, mule account are what accounts? Mule account are those accounts which are misused by those who are using it for money laundering. So if an innocent person has their account, someone will offer them, give the control of the account to me, give me your ATM card, give me your passbook, give me your checkbook, etc. The account will remain in your name, but I will use it. My money will come in, my money will go out without your knowledge. That is a mule account. So first is correct. It relies on static rule-based system to identify suspicious transaction patterns, similar to traditional fraud detection methods. No, that is what we discussed, that this is not any static rule-based method now. This is the entire point of using AI. The entire point is now with the use of AI, with the help of artificial intelligence, there will be certain patterns that will be detected. So there will be less and less of static part, there will be less and less human intervention, it will all be based on machine. So second is wrong. A pilot project with 2 public sector banks demonstrated improved accuracy and speed compared to conventional system. Yes, that did happen. So a couple of public sector banks were chosen by the RBI where this system was launched, and they were able to identify certain accounts which were showing this kind of a pattern. So yes, this is also correct. Fourth, the RBI is promoting mulehunter.ai through a hackathon themed zero financial frauds to encourage innovative solutions for mule account detection. Means what they're trying to say is that RBI is inviting people who are working in this field, in IT, hacking, etc., to come on board, experiment with this technology and suggest how to make it better, how to make it even more improved so that they can detect all these mule accounts. That also is correct. This is something that RBI is doing. Out of the 4 statements, 1, 3 and 4 are correct. So the answer here would be A. This is all that you need to know about mulehunter.ai from RBI. You can take a screenshot from here as well if you want to revise it later on. It will help you. These are the correct statements here. I have one more related question here from this topic. Hopefully you should be able to answer that as well. This is the second question. Again, read it very carefully. Think about what the answer should be. Lock in the answer in your mind. All right, I hope all of you have read this. Consider the following statements regarding mule accounts and RBI's mulehunter.ai initiative. Number 1. By the way, before I go ahead, one very important thing that you must know, because a lot of people usually overlook this. You had to tell which of these is not correct. Okay, which of these is not correct, because in a lot of these cases, when the UPSC asks you question that which of these is incorrect, which of these is not correct, this is where many people actually falter. So make sure that you do read this word. You have to tell which of these is not correct, means which of these is wrong. Now let's see. Mule accounts are typically operated by individuals who knowingly participate in money laundering activities for financial gain. What do you think? Is it knowingly? Is it unknowingly? Think about it. Let's go to the second one, then we can think about it. Second, MuleHunter.ai leverages data from multiple banks and payment system operators to identify 19 distinct behavioral patterns associated with mule accounts. Yes, we did discuss it. These are 19 patterns that they work on. So second one is correct. Third, the introduction of MuleHunter.ai aligns with RBI's effort to strengthen cybersecurity, comply with anti-money laundering regulation. That also is correct. This is also something that they do. RBI is trying to rectify that. RBI is trying to make sure that all the money laundering cases are actually looked into. Fourth, the National Crime Record Bureau reported that mule accounts contribute to over 50% of financial threats across to institutions 2023. See, the National Crime Record Bureau has said that mule accounts are a threat. Mule accounts should be curtailed, but they have not given this data. This precise data that over 50% of the frauds are happening because of mule account, that data is not available. So fourth is wrong. Come back to the first one. The first one was mule accounts are typically operated by individuals who knowingly participate in money laundering. As I told you, they are unknowingly participating. They don't know where the account is being used. If they knew that this is the account or my account is being misused, in most of the cases they might not allow it. The reason why they hand over the control of their account, the reason why they are happy to hand over, let's say, their checkbook, their passwords and their ATM card, is because they don't know where the account will be used. So they unknowingly use it. Now you had to tell which of these is not correct. So not correct ones are 1 and 4. These two are not correct, the other ones are correct. So the answer here would be A. The answer would be A, because you had to tell which of these is not correct. Just let me correct that over here as well. If you are taking a screenshot, this is A, because you have to tell which of these is not correct. If you want a screenshot, you can take it. This will be helpful for your revision as well. As I said, there is no precise available data that it will be 50% or 50% of these financial frauds are happening because of this. There is a warning from National Crime Record Bureau, but there is no such exact data coming in. Now, I have a related previous year question related to RBI. Now, RBI anyways remains a very, very frequently asked topic by the UPSC about the working of the RBI, the powers of the RBI, the regulation that the RBI imposes on the market. All of that is asked very, very regularly. Every single year, you always see 1 or 2 questions about RBI. So, with that in mind, you should know a lot about RBI. Let's see if you can answer this question. This was asked in 2012. Think about what the answer should be. All right. So the question is, the RBI acts as a banker's bank. This would imply which of the following? Means RBI is called as a banker's bank. What is the meaning of this? First, bank retains their deposit with the RBI. That is correct. As you know, the RBI mandates the banks to keep some of the money with the RBI, like the CRR, the cash reserve ratio. Banks also can give loan to the RBI in the form of reverse repo. So a lot of their money is parked with the RBI. RBI lends funds to commercial banks in times of need. Yes, they do that. We have discussed about this. They give money in the form of repo rate. They also give money in the form of marginal standing facility. They also give money in exchange for something called the bank rate, which is without any securities. So all of this indicates how the banks do get funds from RBI. Third, the RBI advises commercial banks on monetary matters. Yes, it does. They advise on a lot of things about where the loan should go, what are the parameters that they should keep in mind for their proper working. All that is done by RBI. All of that is true, and that is what implies when we say that the RBI is the banker's bank. The answer there would be D. All these are correct. These are the functions, the mandate, the responsibility of what the RBI has towards the bank. So all this is correct. If you want, you can take a screenshot here. It will help you in revising later on. This was our first topic for the day. Moving on to the next topic then. The next topic that we have is Nidhi companies. Companies that are an important part of our financial ecosystem. Now, in the financial ecosystem, a majority of it is controlled by the banks. But apart from the banks, also there are another kind of companies which are called as NBFCs. You might have heard of something called NBFC. NBFC is non-banking financial companies. Non-banking financial companies. Basically, those companies which are not bank, means the companies that are not taking anyone's deposit, but they do offer some financial services like the banks do. Most famously, for example, you would get a lot of call these days. You are talking from Bajaj Finance, you are offering you this loan. We are calling from this, we are offering you loan against gold. So these companies that are ready to offer you loan, but they don't have anyone's account. So you can't open up an account in them. They don't take deposits from you, but they do offer you some of the banking services, mainly loans. These are called NBFCs, non-banking financial companies. The Nidhi companies are an example of a non-banking financial company. However, they are not like Bajaj Finance, etc. They are slightly different. Different in the sense that Nidhi companies are those where some people come together, pool in their capital, and the loans then are given to only the members. Like Bajaj Finance, for example, will give a loan randomly to anyone. They don't have to be an employee of Bajaj Finance. But here Nidhi companies are those that will give out loans specifically to those individuals who are members of the companies. This is why these are different as compared to other NBFCs. Now, over the past few years, we have seen some concerns about Nidhi companies. We have seen how certain Nidhi companies are not following the rules and regulations that they are supposed to. That is why there is a keen eye on them. One other problem or kind of a feature for Nidhi company is, because it is not a bank, because it is a company, it is not regulated by the Reserve Bank of India. Please understand this. The RBI regulates the banks. The banks are under the purview of the RBI. Whatever the RBI says, the bank must follow. Otherwise, there will be punishment against them. Nidhi companies are not under the RBI. They are registered companies under the Companies Act. So we have the Companies Act in India, under which the companies have to register themselves and then they are looked into. But they are not under the RBI. That is what sets Nidhi companies apart as compared to others. So the reason why it is in the news is because they are under Companies Act, so they are under control registrar of companies who impose certain penalties on a few Nidhi companies because they are violating the norms. This is why it is in the news. Now, what are these norms? What are Nidhi companies? What do they do? Let's have a deeper look into that. So as I said, first point, they are registered under the Companies Act and they are a kind of a non-banking financial company or non-banking financing company, means NBFC. Now, their purpose is to give out loans, but the difference is, unlike banks who give out loans to common citizens, Nidhi companies give out loans to their members. It's more of, I don't want to say very similar, but you know, these kitty that you have, the kitty party system, where many people come together, pool in their funds. So let's say if there are 10 members, all of them bring 10,000 rupees. So the capital becomes 1 lakh. This 1 lakh rupee will be given out to one of them. So they will have everyone's name on a chit. They will take the chit out. Whoever's name comes out will be the person who will get this money. That is a simple idea. It's very similar to what Nidhi companies are. Again, I'm oversimplifying, but similar to that, because in a kitty kind of a system, again, you are giving money to one of your members only. You are not saying that we have 1 lakh rupees and now we'll give it to someone who is not a part of our group. Yet this money only will be given to someone who is a part of that group, who is a member of that kitty. Similar to this is how the Nidhi companies work. Now, as I said, these are not registered, these are not regulated, or they don't have a license by the RBI because they work under the Companies Act. So they are not something to be considered as a bank. They are far away from a bank, they are not regulated by the RBI. That is a difference between them and the other orthodox banks that we have. Now, there are certain requirements that are imposed on them. There are certain rules and regulations that they have to follow. First, to establish a Nidhi company, you should have at least 7 members. So it's not that 2 or 3 people can come together and register a company as a Nidhi company. In order to do that, you have to have at least 7 members. Out of these 7, minimum 3 should serve as directors. Meaning that one person alone cannot just randomly take the decisions for the company. When the company has to decide something, the board of directors together would have to take a decision by majority. So there have to be at least 3 people who should be directors in a Nidhi company. Also, what about the share capital? How much money should they have? Minimum of 5 lakh rupees is required as equity share capital to start a company, and they can't issue preference shares. So basically, they have to make sure that everyone contributes, and the contribution of the members should be at least 5 lakh. In case of banks, it is called the minimum paid up capital. So for example, if you have to open up a new bank, RBI can say that you should have at least 500 crore rupees of your own money. You should pull in, because once you start, you can't depend that the money will only come in from RBI, the money will only come in from people's deposit. You would also have to have some of your own money. So the banks, for example, may be told that the minimum paid up capital should be 500 crore to apply for an RBI license. Similarly, with Nidhi companies, if you have to set up such kind of a company, you should have at least a minimum capital of 5 lakh rupees to start your business operations. There are many benefits that a Nidhi company carries, a Nidhi company has. It's easier to register because you do not require licenses from the RBI. There is no limit on maximum number of members. There is a limit on minimum members. We just saw at least 7 members, but the maximum members can be any number, hundreds, thousands, whatever people are comfortable with. Also, there is limited capital requirement because, see, as I told you, in case of banks, the minimum paid up capital requirement can be something like 500 crore. Here, the capital requirement is only being imposed at 5 lakh, which is obviously much more affordable, much easier for such companies to start. No requirement for license, mutual benefit for members only. It can also offer loan against security, but again, loan can only be offered to the members. They only operate within the members. So if you have to take advantage of this company, you have to become a member, you have to pull in some of your own capital, only then you would be able to do that. They run professionally because they are registered under the Companies Act. These are not an informal structure, these are properly run formal companies. Now, there are certain strict conditions that a company has to fulfill in order to be qualified for Nidhi status. Why is this qualification important? Because when you qualify for this status, there are certain benefits that you would get from the side of the government. So in order for you to actually get certified as a Nidhi company, these are certain things that you have to follow. Within 1 year of your registration, so if you started your company today, within 1 year from today, these are certain things that you have to fulfill. First, within 1 year of registration, the company should have minimum of 200 members. So starting point was minimum 7 members, but within 1 year, you have to grow to at least 200 members, if not more than that. Second, net funds within 1 year should be 10 lakh or more. So as I said, we start with at least 5 lakh, that is a minimum, but within 1 year, you should reach at least 10 lakh rupees. And it's not that difficult if you have reached the 200 member limit as well. Unencumbered term deposit means deposits without any corrections as such. That is, must be 10% or higher of the outstanding deposit. So whatever loan that you have given out, whatever money that you have rolled out, at least 10% of that should be with you in the term deposit form. So there are 2 types of deposits. As you know, there is something called demand deposit and then there's something called term deposit. NBFCs don't take demand deposit. So demand deposit is when you put your money in the bank in, let's say, the savings account. You can demand that money from the bank whenever you want. So you go to the bank, you tell them that this is the money that I have in my account. I am giving you the check, give me the money back. So you can demand your money back at any point of time. That is called as a demand deposit. On the other hand, term deposit means money that will be given back to you after a certain specific amount of time. Let's say when you have a fixed deposit in the bank, or when you do a recurring deposit in the bank, that money is gone for or fixed or basically out of your reach for some time. That is called a term deposit. In banks, they take demand deposit as well, term deposit as well. NBFCs cannot take demand deposits. NBFCs are not allowed to take demand deposits, so they can only have term deposit. That should be at least 10% of all the loans that they have given. The ratio of net owned funds to deposits should not be more than 1:20. So the net funds that they have, if you compare that to the deposits, it should not be, the ratio should not be more than 1:20. All of this has to be fulfilled within 1 year of registration. So within 1 year of the company coming into being, all this has to be fulfilled in order for you to get the Nidhi status. Just a second. Yeah. Now, the Nidhi companies, when they are giving out the money, first condition as we discussed, they can only give out the loan, they can only give out the money to their members. Secondly, even when they are giving out the money, it has to be strictly monitored for what activities are they giving out money. So they can't randomly give out money for anything. There are certain specific things on which the money can be given out, and there are certain things that are banned. For example, whatever money the Nidhi companies have, they cannot engage in financial activities such as chit funds, they cannot hire purchase finance, they cannot lease finance, insurance, etc. Nothing like that can be an application of the money that they have. This is something that the banks, etc. or other entities do. They are also prohibited from accepting deposits. As I discussed, they can't take deposits. Thirdly, the loans that they give out can only be given out to the members. That is the biggest restriction of Nidhi companies. Only people who are members. Now, in order to become a member, you first have to give some money, deposit some money, because it is, at the end of the day, it is a shared capital. It's again a kind of a group that has pooled in their resources, pooled in their money, and then they are the ones who are taking advantage of this. So loans can only be given out to the members. They are barred from issuing any preference shares, debentures, or any kind of other debt instrument. They cannot take current account or for any of their members. So basically, they can't even issue some preference shares. So no one can be given preference over the others. Preference shares basically means kind of shares that will get liquidated at first. They will be getting the preference over the others. They can't issue that as well. Every shareholder, everyone who has shares will be considered equal. All of their shares will have the same value, will be liquidated at the same kind of value and would be liquidated at the same time. These are certain restrictions that have been imposed on Nidhi companies. Now, just to put things into context about non-banking companies, as I said earlier, India has a long tradition of non-banking financial companies called NBFCs. A lot of them you would see in the market giving out loans, Bajaj Finance, etc., LIC, all these are non-banking financial companies. They are not banks, but they do offer some of the features of banks, specifically giving out loans. So, if you see non-banking financial companies, some of them are registered with RBI, some of them are not registered with RBI, depends upon what their structure is. Some of them are regulated by some other regulators as well. So, for example, SEBI, Security and Exchange Board of India, National Housing Bank, Ministry of Corporate Affairs, IRDA for insurance companies. There are many other agencies in India apart from the RBI as well that try and regulate these companies on a case-to-case basis. This is how the structure of NBFCs, etc. works in India right now. This was all the knowledge and information that you needed about the Nidhi companies. Now, let's see if you got this in your mind, if you were able to understand this. Let's see if you are able to answer this question. Read this carefully and think about what the answer should be. All right, let's see. I hope all of you have gotten this. With reference to Nidhi companies in India, consider the following statements. Number one, Nidhi companies are regulated under the Companies Act of 2013 and are classified as NBFCs under Reserve Bank of India. Yes, we discussed this. See, they are classified as NBFC under Reserve Bank of India. This part does not mean that they are licensed by Reserve Bank of India. So don't get confused. You don't have this doubt in your mind, oh, that earlier we discussed that RBI license is not required. Now we are saying they are regarded as NBFC by RBI. Yes, RBI regards them as NBFCs, but RBI does not give a license for them. So first is correct. A Nidhi company must have a minimum 200 members within 1 year of its incorporation to comply with regulatory requirements. Yes, we discussed this. We discussed what are the requirements that they must fulfill within 1 year of coming into the picture, within 1 year of incorporation. This is one of the requirements. At least 200 members, this number at least should be achieved. Third, Nidhi companies are permitted to accept deposits from and lend only to their members, functioning as a mutual benefit societies. We discuss this, more like a kitty party kind of a thing. When you have a kitty, when some members come in, pool their resources, pool their money, take out a chit. Does that in Nidhi company, you are not taking out a chit. It is based on the requirement, based on your need. If you need it, you demand or you say that I need this money, please give this money to me, and the money will be given to them. It's not on the basis of luck. The chit is not being taken out here. Nidhi Amendment Rules 2022 mandate prior approval from the Registrar of Companies for establishing new branches outside the state of registration. That is slightly technical. That is actually wrong. There are certain restrictions that have been imposed on them because a lot of Nidhi companies have been caught in some financial fraud. A lot of Nidhi companies, as we discussed, the reason why it is in the news is that some Nidhi companies have been fined also by the government, and the reason is this only, that they were not complying by the regulations. This is where the government of India has tried to make it slightly more strict for them, but this is wrong. It is not like now for establishing new branches outside the state they have to take permission. That is not true. 1, 2 and 3 are correct. A would be the answer here. A is the answer here. I hope you got this one right. If you want, you can take a screenshot of the explanation. This is the explanation of it. Read it carefully. Take a screenshot. If you just look at the fourth statement, as I said, there are stricter regulations. They have to do mandatory declarations about their working, how much loan have they given out, etc. But it's not that they have to ask for permission every time they open up a new branch outside their state. No, that is not true. One more practice question. Let's see if we can read this. Try and see and identify the answer here. Before you make up your mind, again, let me remind you here also, you are supposed to tell which of these is not correct. So don't ignore this part. Students mostly have this habit, which is not a great habit, that they only read these statements. They don't even read what is above this, and they don't read what is below this. Somehow you have a blind eye towards this. Somehow most of students will read this part and then they would read the options, which is a bad habit. Try and correct that. Read the entire thing. You have to tell which of these is not correct. Now make up your mind and see if you are able to answer this. Got it? All right, let's see if you can answer. Consider the following statements regarding regulatory framework for Nidhi companies in India. First, Nidhi Amendment Rules 2022 increase the minimum net owned funds requirement for Nidhi companies from 5 lakh to 10 lakh rupees. That is correct. The minimum capital that they should have, the minimum net owned fund, the funds that they control, the funds that have been given by the all the citizens, all the members rather, has to be at least 10 lakh within 1 year of the incorporation. We just discussed this. These are some of the requirements that they have. Nidhi companies are prohibited from issuing preference shares or debentures to raise funds from their members. Yes, that is correct. We discussed this. Just because they want to raise funds from their members, in exchange of those funds, they cannot issue debentures, they cannot issue preference shares. These are ways in which money can be raised. Third, Registrar of Companies can direct the closure of a Nidhi company if it fails to file the form NDH4 within the stipulated year after incorporation. That is also correct. So these are declaration forms that the Nidhi companies have to fill. Declaration forms giving out information about how many members do they have, how much capital have they pulled in, how much capital do they have now, about their working. So once they come into being within a stipulated amount of time, they have to fulfill this form, otherwise their registration can be cancelled. As per the Economic Survey 24-25, Nidhi companies contributed significantly to financial inclusion by mobilizing 1 lakh crore in deposits from rural households. Now, while there has been talk about Nidhi companies being able to bring in more people and get them into financial inclusion, but the fact that 1 lakh crore rupees was deposited, no, that has not been certified anywhere. Economic Survey does not give this data, does not give this figure. They do not say that Nidhi companies have accounted for this much deposit. There is a mention that these Nidhi companies have played an important role in financial inclusion. So if the statement would have been until this, it would have been correct. But when you add a certain figure that the Economic Survey gives this figure, that is wrong. They do not give this figure. Fourth is wrong. So now because you had to tell which of these is not correct, the only one that is not correct is 4 only. So the answer here is C. Again, you have to tell which of these is not correct. C would be the answer here. This is not correct. Others are correct. If you want, you can take a screenshot here. It is an important information. Nidhi companies are important. NBFCs, financial companies usually are some of those topics that do get asked very frequently. Moving on to a related previous year question. Again, a question related to the RBI. Let's see if you can answer this. It was a question asked in 2021. Think about this, think about what the answer should be, make up your mind, and then we can discuss. All right, the question is, consider the following statements. Number 1. The governor of the Reserve Bank of India is appointed by the central government. Absolutely correct. The RBI governor is appointed by the central government. That has also been slightly controversial now. We are seeing increasingly people who are closer to the government ideology, the way that the government thinks, are being appointed to the RBI. That is correct. Second, certain provisions in the Constitution of India give the central government the right to issue directions to the RBI in the public interest. No. So, Constitution of India does not mention about RBI. The powers of the RBI, the working of the RBI, everything about RBI is in the RBI Act of 1934. So, what directions can be given or cannot be given, anything like that is not mentioned in the Constitution of India. It is all derived from RBI Act of 1934. Third, the governor of RBI draws the power from the RBI Act. That is correct. This is what we had discussed. What the governor can do, what the RBI can do, what the government can do with respect to the RBI, everything about that is mentioned in the RBI Act of 1934. It is not mentioned in the Constitution. Constitution has nothing to do with it. So 1 and 3 are correct here. Answer is C. Second statement is wrong. 1 and 3 are correct. I hope you got this one right. This was a pretty easy question by the standards of what the kind of question that are asked. Pretty easy question. It was asked in 2021. This is the explanation part. If you want, you can take a screenshot here for revising later on. Moving on to the next topic that is in the news, that usually remains in the news every few months, something called the masala bonds. Now, what exactly are masala bonds? What exactly is this? Simple idea. If an Indian company or even the Indian government, for example, has to take some money from outside the country. So, usually what happens when, let's say, an Indian company wants to take funds, wants to take a loan from the US. So, you go to the US, try and take funds from their bank, try and take funds from the investors there. The money that they will give you will be, the agreement will be, let's say, in dollars, that I have given you, let's say, $1 crore or $10 million, I am giving it to you. So, when you have to return this, return to me in the form of dollar only. Understand this. I am giving you the loan, let's say $10 million. So, when you return back, you have to give $10 million plus the interest, whatever the interest we decide. The problem with that usual system is that, for example, let's say the time that the loan was given, at that time, let's say $1 was equal to 60 rupees. let's say at that time when the loan was given, $1 was equal to 60 rupees. The time that now the loan is being given back, when the loan is being repaid, let's assume now $1 has become equal to 85 rupees. Now, because the loan has to be repaid in dollar only, the person or the company who has to repay the loan has to spend so much more Indian rupees to buy the same dollar. So even though it is not in their control, see, the value of rupee as compared to dollar is not in the control of that one company. But even then, they have to face huge losses just because they have to spend a lot more money now in Indian rupees to buy that many dollars and pay interest in those dollars. So that is not an ideal situation, especially in case of India, where our currency in exchange for dollar in the long period only declines. There has never been a, let's say, 5-year period or 10-year period at the end of which our Indian rupee has become stronger than the dollar, has become stronger against the dollar as compared to what it was. At any point of time, if you look at the value of Indian rupee against the dollar and take it, compare the same after 10 years, in every 10-year period, the money has only depreciated, has not appreciated against the dollar. So in the long run, taking this loan becomes a very heavy liability. So now the option or the alternative is something called the masala bonds. Masala bonds, the name masala suggests basically it's an indication that it is an Indian thing. Masala bonds means these bonds are issued by the Indian entities outside India to raise loans which are denominated in Indian rupee. Means the money that you are giving to me, we will consider the agreement will be in the form of Indian rupee. How much rupees are you giving me? So for example, if let's say from today's conversion rate, you are giving me 100 crore rupees from today's conversion rate, then later on after so many years that we decide, I will pay you the money back in the form of Indian rupees only. That I will pay you 100 crore rupees plus whatever the interest is. We are not going to discuss what is the conversion rate of rupees to dollar now and what was it then. We will only discuss about the rupee denominated thing. So these are bonds that are issued in a foreign country, especially to raise funds, that, and these bonds, the unique feature is it is denominated in the Indian currency, that is the Indian rupee. The reason why it is in the news is HDFC has recently planned to issue masala bonds in order to get money. So HDFC is planning to raise $750 million worth of Indian rupees. Why, what are they doing and how are they doing it? They are listing their own masala bonds in the London Stock Exchange. So they'll be listing in the London Stock Exchange. Whoever wants to buy it can. That will be a kind of a loan that the HDFC will have, and they will use that money for their own operations. Because it will be denominated in the Indian rupee, that is why it is called as a masala bond. Now, before you think that, oh, this is a wonderful idea, we did this, it's not an Indian idea. Many countries do this, and they do give these funny or interesting names. For example, let me ask you this bond and you think about it and you tell me which country has this bond. So there's a bond called the dim sum bond. Dim sum, or in India you call these momos or by different name. Let's say dim sum bond. Any idea dim sum bond belongs to which country, or which country issues this in their own local currency? China. So China issues dim sum bonds. We issue masala bonds. So these are similar kind of things that are issued. So it's not something that is new. So masala bonds, as I said, they are rupee denominated bonds to raise capital. The word masala, so that it is very clear it is from India. India well known for spices. They were first introduced by International Finance Corporation, which is a part of the World Bank. I hope all of you have read. World Bank is a group of institutions actually. There is no one single institution called the World Bank. The World Bank actually has 5 institutions together. So if you look at it, World Bank has different institutions. One is called IBRD, one is called IDA, then there is IFC, then there is MEGA, and then there is ICSID. These are the 5 different institutions that together are called as a World Bank Group. The first one to be established was the IBRD. It was the first one. IBRD is International Bank for Reconstruction and Development. This was the institution that was set up first after the Second World War, mainly to give loan to European countries that were destroyed. The infrastructure was destroyed after Second World War. So to give them loan for reconstruction and development, IBRD was set up. Then the IDA came in, International Development Assistance. The difference right now is IDA gives loans to poorest countries. Poorest nations like LDCs, least developed countries. On the other hand, the IBRD gives out loan to, let's say, medium level countries. And that also highlights the difference between the rate of interest offered. The IDA, because it offers loans to the poorest countries, their rate of interest is the least. IBRD, they offer a rate of interest which is slightly higher than the IDA. Then IFC. IFC is that arm of the World Bank that gives out loan to private entities. So private entity, let's say Reliance in India, wants to take a loan from the World Bank. So even they can do that. Private entities are given out loan by the World Bank. That is done by IFC. This is the IFC we are talking about, International Finance Corporation. They are the ones who first started issuing these kind of bonds in India. For India, that is the masala bond. Then there is MEGA. What MEGA does is they basically kind of give an insurance facility for those who are investing money in dangerous entities. Let's take this example. Do you think anyone today would want to invest their money in Afghanistan? Most probably not. You would not invest your money in Afghanistan because you do not know whether your money will be safe or not. You do not know whether the money will come back or not. You do not know whether the investment is safe. So what MEGA does is they encourage you. They tell you that you don't have to worry. You go and invest your money in Afghanistan. If there is something wrong that happens with your capital, if let's say the government shuts it down, there is a war kind of a situation, there is no development that takes place, in that kind of a situation, we will come in and we will compensate your capital for you. This is what MEGA does. Then ICSID. ICSID is the, out of the 5, the only part or the only component where India is not a member is ICSID. We are not a member of ICSID. ICSID, what it does is, it basically mediates international disputes about investment. So some country might have given loan to some other country, might have invested money, then they are not giving it back or there is an issue between them. The World Bank says we will come and mediate. This is done by ICSID. India is not a member here because India's long-standing foreign policy is that we do not want international mediation of issues. We usually consider if there are 2 countries involved, there are 2 parties involved, we think of it as a bilateral issue. We do not want any third party to come in. So we are not a member here. Coming back, the masala bonds were first introduced by IFC. They are the ones who used this in 2014 to raise funds for infrastructure in India. They were successful, and that is when it was adopted by other organizations in India as well, which have been issuing these kind of bonds. So they are, because they are denominated in Indian rupee, that is the biggest advantage. Because of this, you don't have to be concerned about the value of Indian rupee against the dollar. Because as I said, in the long run, rupee does not appreciate against the dollar. In the long run, rupee depreciates against the dollar. So in the long run, when the rupee is losing its value, you don't have to worry about the fact that now I have to give back more money. You just have to pay the same amount of money that is denominated in Indian rupee. You would not have to be concerned about what interest rates or what exchange rates now are being offered. This is what makes your investment safer. Now, where can this money be used? It's not that the masala bond money can be used anywhere. There are certain restrictions on which this money can be used. For example, this money cannot be used for real estate, money coming in from masala bond. This money cannot be used for investing in capital market or domestic equity, cannot be used for land purchase, cannot be used for restricted activities or FDI, etc. It can be used for these kind of purposes, for corporate working capital, for integrated township, affordable housing projects, etc. Because ultimately, if the World Bank is the one that has started this, they would obviously make sure that this kind of a money coming in is used for that section of the society that is unserved or underserved. So affordable housing वगैरह is etc. is where this money can be used. Otherwise, this money cannot be used in these kind of restricted areas. Now, again, this is helpful because it allows you to take money from foreign countries, and secondly, it kind of safeguards you against your currency depreciating against the dollar. Also, it is not just the government that can issue it, both private entities and the government can issue it. In fact, the reason why it is in the news, as we discussed, is HDFC is raising money using these bonds. So HDFC is a private entity. So this is being used by HDFC. It can be used by government entities as well, private entities as well. There is no bar on that. It works on both these accounts. Both of them can take money. Now, we discussed about who can raise money, but there is also another aspect. Who can invest money in this? One part is the people who are raising money, but the other part is the people who are investing money. So who exactly are the people who can invest money? There are strict restrictions on that as well. First, a resident of a country that is a member of FATF can subscribe to this fund. Now, you might have heard of FATF, Financial Action Task Force. If not, remember you might have heard a few months ago news such as Pakistan is in the black list of FATF, or Pakistan is in the grey list of FATF, or Pakistan has now come out of the grey list. You might have heard these kind of news stories. What are these lists? The grey list, the black list, the white list, etc. All that is actually a list, or these kind of lists are given by an organization called FATF, Financial Action Task Force. This is a group, a body that was started by the G7 countries. The G7 countries came together with this idea that we have to stop money laundering around the world. A lot of money, for example, was being given away to terrorist activities. A lot of money was being unaccounted for. So the G7 countries came together, formed a group, and the group's idea was to share financial information, share information about financial transactions with each other, to make sure that they keep an eye on those countries where the governments are unable to stop the money going into the hands of terrorists, going into the hands of those who are using it for criminal activities. That is why countries such as Pakistan were in the grey list. So, only those countries which are members of the FATF, their residents, again not citizens but residents, can invest in these bonds, number one. Secondly, investors who subscribe should be those who have security market regulator as a member of International Organization of Security Commission. Now, what exactly is this? World over, every major country has a stock market like we have in India. Our stock market regulator is SEBI. So, this is how, for example, there are different regulations in different parts of the country, like in different parts of the world. Like US has something called SEC. This is the US regulator. India has something called SEBI. Many of these stock market regulators around the world have come together to make an international organization called as the International Organization of Security Commissions. India also the member here. If your country is a member of this international commission, only then you can invest in the masala bond. So either your country is a member of the FATF, or the regulator of the stock market, regulator of security exchange in your country is a member of this international commission, or multilateral regional financial institutions where India is a member can also subscribe to these bonds. So these are bonds open for a lot of people, but not all. Remember, if you are not a part of this international financial system, you will not be able to put your money or give money into these bonds. Now, every bond has a certain tenure, has a certain maturity date. If you take a bond from the government, for example, the government will have to tell you that come back after these many years, I'll give you your money back along with the interest. So there has to be a maturity period, there has to be a tenure of these bonds. For these masala bonds, the RBI decides a tenure. What is the guideline? It mainly depends upon the amount of money that is being raised. Depending upon that, the maturity period can be determined. So RBI says, if the money that you are raising through masala bonds is equivalent of $50 million, up to this, if you are raising money, then the maturity period has to be at least 5 years. If the amount is basically bigger than this, then the maturity period has to be 5 years. If it is lesser than this, then it has to be 3 years. So depending upon how much money is being raised, if you are raising money which is more than $50 million equivalent of Indian rupee, then the maturity period has to be 5 years minimum. If it is less than that, then it has to be 3 years. How long the maturity period is, exactly the period will be decided by the person or the entity that is issuing the bond. So RBI cannot decide the exact tenure. They can just give you regulation that this is the minimum tenure. Like the HDFC is raising $750 million worth of Indian rupees. So HDFC will decide what is the tenure. They will decide when they have to pay the money back, the principal amount back and the interest back. RBI can just give you the minimum period. So minimum is 3 years for up to $50 million investment, minimum 5 years for more than $50 million investment, and the exact period will be decided by the entity that is issuing these bonds. These are certain benefits that you have of the masala bond. As I told you, the single biggest benefit being that you are not exposed to the fact that rupee might depreciate against the dollar. Even if the rupee depreciates against the dollar, you are not concerned about that. You only have to pay back in Indian rupee only. So your burden will not increase, your repayment burden will not increase just because the money has lost its value or your Indian rupee has lost its value. It will only be based on the interest that you have promised to repay. Certain advantages, higher returns for the people who are investing it, because the people who are issuing the masala bonds have to make it lucrative. Only when you make it lucrative enough for the foreign investor would they bring the money in. It's a confidence booster. If someone sitting in, let's say, US or London Stock Exchange is ready to invest money in an Indian company, it boosts your confidence that okay, they trust us, they are ready to invest in our economy, they are ready to invest in our growth. It also has tax advantages, capital gain tax, etc. Are exempted from here. Apart from this, the currency fluctuation protection, as I said, because this is denominated in Indian currency, so we won't have to worry about how the currency is fluctuating. There are certain benefits for the borrowers who are taking this, that is zero currency risk, large scale funds can be mobilized, because as we just saw, our HDFC is raising funds equivalent to $750 million. This is not a small amount. $750 million would be $75 crore. So imagine $75 crore, that if you convert that to equivalent of Indian rupee, that will be close to something like 6,000 crore rupees. That is not an easy amount of money to be raised within the country. So when you take it from outside, when it is open, you have a lot more opportunities to take funds from outside. The global market gets opened for you, which is why it is extremely, extremely beneficial for you as well. As I said, there are different types of countries that do the same. India is not special in this case. We issue masala bonds. Similarly, there are dim sum bonds that China had issued. China had started to issue this since 2007 rather, so they had been doing it much before India. Again, the same kind of an idea that these bonds will be issued in the Chinese currency. They set their own kind of guidelines for this because they have been doing it much earlier than India. The money that they have raised under this is much more than India. Like for China, so far they have issued these bonds worth $90 billion. For India, it is about $5.5 billion, because again, there's a long difference between when China rolled this out and when we rolled this out. That is why not fair to compare the exact value. If you understood this topic, let's see if you are able to answer a few questions regarding this. Read this carefully and think about what the answer should be. Read this carefully, it's a long question. Done? Okay. With reference to masala bonds in Indian financial market, consider the following statements. Number one, masala bonds are rupee denominated bonds issued by Indian entities in overseas markets to raise funds. Exactly what we discussed. When Indian entities, be it the private entity or the government, when they want funds from foreign market, but in Indian rupee denominated form, that's when masala bonds are rolled out. Currency risk associated with masala bond is borne by the investor as the bonds are settled in Indian rupee. Yes. So the investor is the one who will have to see if the currency that they are using actually deteriorates or weakens or gets stronger. the person who is borrowing it, the borrower does not have to pay the risk associated with it. The risk is of the investor who has given the money, means if their currency has become stronger against the rupee, they might face a loss, but the borrower doesn't have to deal with this. RBI permits only AAA rated Indian companies to issue masala bonds without prior approval? Not really. See, companies are given certain rating depending upon their financial standing. Like AAA plus is the highest level of rating, means if let's say you're a AAA or AAA plus company, that means there are almost zero chances that you would not repay the bond or you would not repay your debt. But this is not how it works. There is no restriction of AAA rated companies only being able to invest or take out their money in exchange for bonds. The IFC issued the first masala bonds in 2014 for infrastructure projects in India. Yes, we did discuss this. IFC is a part of the World Bank Group. It's the entity that gives out loans to the private companies around the world. They are the ones who first issued masala bonds for India in 2014, mainly to give loans for infrastructure projects in India. So 1, 2 and 4, these three are correct. A would be the answer here. A would be the answer here. The third statement here is wrong. 1, 2 and 4 here are correct. I hope you got this one right. If you want, you can take a screenshot here. So for this detailed explanation, you can revise it later on as well. Got this? All right. Next, again read this carefully. See if you are able to answer this. And before you make up your mind, once again reminding you, it is asking you which of these is not correct. Okay, don't ignore the word not here. Think about the answer. Understood? All right. Consider the following statements regarding masala bonds and their role in India's ecosystem. First, masala bonds are listed exclusively on the Singapore Stock Exchange to attract foreign portfolio investors. Is it? No. They can be listed anywhere in the world. In fact, the news that we are discussing, HDFC rolling out these bonds, HDFC itself has listed this in the London Stock Exchange. So no, it is not restricted to Singapore Stock Exchange. Proceeds from masala bond can be used for general corporate purpose, including working capital, debt repayment under RBI's external commercial borrowing framework. Yes, we discussed there are certain restrictions on where it can or cannot be used. Amongst the places or amongst the areas where this money coming into the bonds can be used is working capital of the bank, repayment of debt. Third, in 2023, Asian Development Bank issued masala bonds to support India's renewable energy project. Not really, no. That did not happen. The Asian Development Bank did not issue any such masala bonds to help India. Masala bonds have contributed to deepening India's corporate bond market with issuance exceeding 50,000 crore by 2024. This is correct. We discussed that India's masala bonds that have been issued till now about $5.5 billion. So yes, this is correct. It has well above the 50,000 crore mark. The answer thus, because you had to tell which of these is not correct, 1 and 3 are not correct. So B would be the correct answer here. These two statements are incorrect. This is what you had to tell, the ones that are incorrect here. You can take a screenshot of this explanation if you wish. You can revise it later on. Now, I have a related previous year question here for you, something related to the working of the RBI. Read this and see if you can get to the correct answer. This was a question asked in 2019. Think about this. Which one of the following is not the most likely measure the government or the RBI takes to stop the slide of Indian rupee? Now, just get this basic idea in your mind. Why does a rupee slide, or why does a rupee become stronger against the dollar? The simple argument is It depends on how much dollars we have in the Indian market. If we have more dollars in the Indian market, Indian rupee will strengthen. If we have lesser dollars in the Indian market, if the amount of dollars are reducing, the money will continue to slide. So now the question is, if the RBI has to stop the slide, which of this they will not do? They will not do, okay? So which of this basically will result in going out of even more dollars? Because this is what they will not do. That is what you have to identify. Curbing imports of non-essential goods and promoting exports. What do you think? Would they do that? That is curbing the import of non-essential goods and promoting exports. Think about this. Second, encouraging Indian borrowers to issue rupee-denominated masala bonds. Third, easing conditions relating to external commercial borrowings, making it easier for the money to come in. Following an expansionary monetary policy means giving out more money in the market. Which of this will they not do in order? Which of this will they not do in order to stop the slide of Indian rupee? The answer here is A. They will not curb import of non-essential goods and promote export. Why is that the case? Because curbing of these goods is something that they would result in, or that would result in an opposite kind of a reaction, an opposite kind of an impact. This is something that most probably they will not do. Next topic that we have here is unified lending interface. Now what exactly is this? See, in the Indian market, one big issue that we have here, and this is true across boards, across different sectors, be it agriculture, be it MSME, the one big issue that we have in India is the access of money, the access of loans, the access of lending opportunities. Different banks, different NBFCs, for example, try and decide their own methods of whether a certain person is eligible to take loans or not. There's a lot of exchange of information required. You need to submit a lot of documents then are looked into. Credit companies are involved, there is CIBIL rating is involved. A lot of these players come in between in order for anyone to take loan. That is a very complicated process. You apply to a bank, the bank will check your CIBIL score, they will check your financial information, then your account statements will be checked, your PAN card, etc. is it linked or not, all that will be checked, and then the decision is taken. Now that makes it a very complicated process. In order to simplify that, in order to make sure that that actually becomes better, the RBI has started something called a unified lending interface. Now the idea is simple. Unified lending interface is a platform where the person who is requesting a loan and the entity that is giving out the loan, they can actually come together, and the process is made simpler, the process is made easier to give out loans. The exchange of information is available. So any company, for example, who is offering a loan to an individual or offering a loan to another organization would get access to their bank account statements, would get access to their information, so that they can make a clear-cut decision whether the loan has to be given or not. RBI is now ready to launch this. That is why it is in the news. It is called the Unified Lending Interface, that is the ULI. It will be launched at the at the national level. There will be a national rollout. It's a platform for lending interface, that is for people who want to take loan from multiple organizations. They can come in, they can list their requirements here. So it's a digital platform. There will be a seamless access to credit, especially aimed at farmers and MSME. It's not restricted to them only. It's not that only the MSME and the farmers can take a loan from here, but yes, it is mainly aimed at them, that they would be able to take advantage of this, that is farmers and MSMEs, for them, because they are the ones who face a lot of difficulties in getting loan, who face a lot of difficulties and complications in getting all the paperwork together in order to apply for the loan. For them specifically, it will make the process much easier. These are the key features of that interface. Number one, consent-based digital access means, let's say you apply for a loan. When you usually apply for a loan, the bank asks you for 20 different types of documents. Give me this and that. You have to collect all of that. In place of that, in this platform, you just have to give a consent that, am I ready to share these details with the lender? Am I ready to share these details with the bank? When you say, yes, I am ready to share my details, the banks will automatically be given your details, your financial data, your bank account information, etc. How much are you earning? How much profit are you making? How much tax have you given out? All that detail will already be shared, automatically be shared with the bank. You just have to give your digital consent. As soon as you say yes, that will be given to them. Then there will be APIs. API basically are kind of plug and play algorithm kind of a thing, that any institution, let's say any banking institution, any institution that gives out loans to the people, also want to come on this interface. They also want to use this. There is no technical complexity attached to it. They will be given an API, a kind of an algorithm will be given to them, and using this they can just plug and play. They can get their platform attached to unified lending surface and unified lending interface, and they won't have to do any programming as such. That is called a plug and a play system. Like, think of it like the pen drive that you have. When you just connect pen drive to your computer or your laptop, you don't have to do any programming or you don't have to run any program. You just plug it and automatically you will see that you are able to see the files that are stored in that pen drive. There is no complication attached to that. That's called a plug and a play system, that you just put it on and that is good to go. These are UPIs. This is the plug and play concept. The important feature of this, how is it that it will be able to share all that information in a convenient manner? How is it that it will make sure all this information is up to date? They will be using the government's JAM Aadhaar Trinity, that is Jan Dhan Aadhaar Mobile Trinity. A lot of it will be based on UPI, because with the help of UPI, you do have financial information of a lot of people. Because Aadhaar cards have been linked to the bank account, and people's bank account information is with the government in the form of Jan Dhan account specifically, the government will be able to identify your financial transactions. It has become increasingly difficult, for example, to hide your financial transactions, because the government has made sure that as many things as possible right now are linked to your Aadhaar card. And when they are linked to your Aadhaar card, that cannot be duplicated. That means that one single person can only have this bank account, and this bank account will give you most of the information about your financial transaction, money coming in, money going out. So when a bank is offering you a loan and they want to see your bank account transactions, they want to see how much are you usually earning, how much money usually goes out of your account, they just have to use this platform and all this information will be given to them anyways. This is what the unified lending interface is all about. Again, the RBI has been working on it for a long time. They have been trying to solve this problem of loan giving and loan taking in India, because it requires an exchange of a lot of documents. It is a complicated process. The government of India, or the RBI specifically, is trying to simplify that. For that, the unified lending surface or lending interface can actually play an extremely important role. This is the benefit. First, seamless credit access for farmers and MSME specifically. It will be much easier for them to get loans now. They won't have to get caught up in the complications of paperwork. It will have faster credit appraisal, means the processing time will be cut short. They will get access to information instantly. Centralized database, all the database will be in front of you, so you won't have to go and you won't have to search for any other platform. Targeted support for agriculture and MSME, again, it is specifically designed for them mainly to look into their issues. It's not just restricted to MSME and agricultures. There can be others also who can apply, but mostly it is them who would be able to take advantage. Specifically, the portal is to solve their issue, because they are the ones who need credit, and credit does not get available to them in a easier and convenient manner. Now, apart from this, there are other platforms as well from where money lending happens in India apart from banks. It's not that apart from banks you don't have an option to get money or to borrow money in India. We have something called Public Credit Registry. It's a central database that has information of all the borrowers in the country. Whoever has taken any money, whoever has borrowed loans, etc., all that information is available in something called Public Credit Registry. There's also something called Account Aggregator Framework. This again is a platform run by the RBI that has account of all the lenders that have been giving their money. They try and mark which of the people are or have a good enough record to be given out the loan. that information can be used by others as well. So this is something that enables sharing of information. There is trade receivable discounting system as well. It's an interesting system where, let's say I am a farmer, I have sold my produce to a company and they have not given the money to me right now. I have a bill, I have an invoice that says the company will give me 5 lakh rupees, but not right now, they will give it to me after 2 months. If I can't wait for 2 months, I need the money immediately. What do? I sell my bill, my invoice to someone. So I sell my invoice to someone and tell him, you pay me 4.5 lakh rupees right now. You take the bill, wait for 2 months. After 2 months, they will give you 5 lakh rupees. So if you're ready to wait, you will make a profit. You can buy these bills. So buying of these bills, buying of these invoice from the farmer because they can't wait, they want the money immediately. That is called trade receivable discounting system, where the MSMEs, etc., it is a big problem with the MSME. When they sell the stuff in the market, they are not paid the money immediately. They have a bill, they have an invoice that will be given, the money will be given to them after 60 days, after 90 days. So if they can't wait, they will sell their bill or invoice to someone who can wait. At a discount, they will pay the money to MSME upfront and they will then get the money from the market. Then there's also got peer-to-peer lending platforms. Peer-to-peer lending means where you take loan from an individual. Let's say not the bank, but there's an individual with some money who is ready to give you the loan. That is called peer-to-peer lending. There are certain platforms that provide that option as well. So these are different kind of options that you have in order to take money. It's not just from the banks that money can be taken. If you understood that, let's see if you're able to answer these questions. Again, read this carefully. Read this carefully. Think about what the answer would be. If you have, let's see. With reference to unified lending interface introduced by RBI, consider the following statements. Number 1, ULI is a digital platform developed by RBI Innovation Hub to facilitate seamless credit access using standardized APIs. Yes, it is the perfect definition. That is what this interface is about. It will make it easier for you to apply for loans, for the banks to give you the loans. It will make it easier for the documentation, for the information to exchange, etc. It primarily aims to enhance credit delivery to farmers and MSME by integrating financial and non-financial data such as land records. Yes. So all the data that the banks would require before making their decision whether they want to give out a loan or not, all that data will be made available on these platforms so that the bank can take a decision. So it will be land records, how much money they have earned earlier, how much money do they have now, all that data will be on that platform. The platform operates on a plug and play model requiring extensive technical integration, or that is opposite of it. Plug and play model means no technical integration is required. Just an API, you run that program and that is enough and your program will start, you will be integrated. Plug and play itself means no technical expertise is required. So third is wrong. A pilot project for ULI initiated in 2022 focused on digitalizing Kisan credit card loans up to 1.6 lakh rupees in select state. That is correct. The RBI, as I said, had been running a pilot project to see if this is successful and they were able to get improved results, wherein Kisan credit card loans that the farmers take. So Kisan credit card, for example, earlier had a 2 lakh limit, now has a 5 lakh limit. So Kisan credit card loans up to 1.6 lakh were given under this platform only, all online without the need to have any physical data transferred or physically documentation being transferred. That was not done. 1, 2 and 4 here are correct. A would be the correct answer here. A is the answer here about this particular initiative. You can take a screenshot here if you wish to revise later on. Moving on to the next question. Again, read this carefully, and once again you had to tell which of these is not correct. Okay, mark your answer on the basis of which of these is incorrect. Think about it now. Got it? All right. Consider the following statements regarding unified lending interface and its implications for India's financial ecosystem. First, it is designed to reduce the cost and time of credit appraisal by enabling real-time data access from multiple sources for lenders. That is correct. That is what this is doing. It is making sure that the banks and all these institutions that are ready to give you the loan, they are all present on that platform, and they will be able to get information real time about your bank account, your land records, etc., how much money you have. All that decision can be taken real time. So first is correct. Second, unlike the UPI, ULI does not rely on consent-based data sharing to protect borrower privacy. That is wrong. We discussed this. It is based on consent, means your bank account information, for example, will not be shared without you saying yes. You will first be asked for your consent. Only when you say yes, that I am fine with my bank account data or my financial data being shared with the lenders, being shared with the banks, only when you say yes, then the data will be shared. So it is all consent based. Platform is expected to increase credit penetration, particularly in rural areas, where MSME's credit stands at 14% as of 2024. That is correct, because the aim is mainly to target farmers and the MSME, because they don't have access to credit. In the rural areas, MSME only made up 14% credit, means the loans that were given out, only 14% were to the MSME. So the expectation is, since the process has become easier, it will make it easier for them to get loans. It will make it easier and more trustworthy for the banks also to give out the loans. Next, Economic Survey 24-25 credits ULI's pilot phase with doubling credit disbursal for small farmers in participating states. Not really. So the Economic Survey did say that this is a good initiative. They talked about the potential that it has, but that number was not given. This data that they have doubled the disbursal for small farmers, no, that is just an assumption. There is no data about that in Economic Survey that would say that disbursal has doubled. You have to tell which of these is not correct. 2 and 4 are incorrect here. So the answer here would be A. Incorrect ones are 2 and 4. A is the correct answer here. I hope you got this right. You can take a screenshot from here if you wish for revision later on. All right, I have now a related previous year question. Let's see if you can read this and try and think about the answer. Read this carefully. Done? In India, the central banks function as the lender of the last resort usually refers to which of the following? They are talking about the RBI. The RBI is often called as a lender of the last resort. What do we mean by that? Number one, lending to trade and industry bodies when they fail to borrow from other sources. No, RBI does not lend to any trade bodies or industry bodies. See, they have to take a loan from the banks only. The banks in turn can take a loan from the RBI, but RBI does not directly intervene and tell the banks that you go aside and you take a step aside, I will give the loan. No, RBI does not give out loan to trade bodies, etc. These are given out by the banks only. RBI gives them the loan on a case-to-case basis. Providing liquidity to the banks having a temporary crisis. Yes, we did discuss. This is something that the RBI does. This is where you have repo rate. When the banks take loan in exchange for security, you have something called bank rate, where the banks take loan without a security, so it's a higher rate of interest. You also have marginal standing facility, where short-term loans are taken by the bank from the RBI. So there are many ways in which the RBI does give out money, loan, liquidity to the banks. Second is correct. Lending to governments to finance budgetary deficit, no, they have stopped doing that. They used to do that earlier. Earlier, whenever the government or whatever deficit they used to have in the budget, the money that they lacked, they could not have enough money for spending, they used to just take it from the RBI. That was a practice that stopped in the late 1990s. After late 1990s, that has not happened. So this question was in 2021. So no, this is also wrong. 2 only is correct. This is B. B, this is the reason why it is called, RBI is called as the lender of the last resort. If you want, you can take a screenshot as well here. This will help you to revise later on. And with this, we come to the end of today's session. I hope it was helpful and you learned some new things today. This, as you know, is an ongoing series where we have been trying to prepare you with the most important current affairs for economics before this upcoming prelims examination. Once again, join us tomorrow at 12 p.m. And if you are new here, do hit the like and the subscribe button. Do make sure you invite your other friends as well. Keep coming here every single day so that you can get hold of all the current affairs regarding economics. My name is Harshmeet Singh and I was representing the Ranayana IAS Academy. Thank you so much. Bye-bye. Jai Hind.